Today is 12/17/2014. It is 10:16. We're at New York City Comptroller's Office, 1 Center Street, room 530, New York, New York. We need a roll call of trustees.
Ms. Caroline Walker.
Here.
Ms. Suzanne Vickers.
Here.
Mr. Antonio Rodriguez. Mr. Steve Cassidy.
James Levin is Steve Cassidy's proxy.
And Mr. James Levin. Here. Mr. Eddie Brown. Mr. John Kelly.
Present.
Mr. James McGowan.
Here.
Mr. John Pereira. Here. Mr. Paul Furrow.
Here.
Mr. Thomas Phelan.
Here.
Commissioner Douglas White.
Here.
We have 24 votes and a quorum. We may start the meeting.
We can start the public agenda.
Okay, thanks very much. We have a lot of things to get through. We will try to get through them in an expedient manner. And so we're going to get right into it with the quarterly review. If you turn to the spiral-bound book, turn to page 8. We'll review the details of the quarter. I'm going to go through our performance, the benchmark performance, and then I'm going to drill into where the differences came from, so that when you hear the reports from the managers, you have a sense of where the differences came from during the quarter. So if you turn to page 8, go all the way over to the left, you can see that during the quarter, the portfolio was down 0.9% versus a benchmark that was down 0.46%. Please ignore the gray item. That was a research project that somehow ended up in the quarterly reports. My apologies. So the difference there is 44 basis points. So if we want to drill down further, let's go to page 11. See some bar charts there. You'll see that the same 0.9% negative total plan return, the policy index return of minus 0.46. So the difference, the excess return, is negative for the quarter, 44 basis points. So let's break down that 44 basis points, and we do that in the last two panels. 0.5 negative allocation effect and 0.39 selection effect. So the allocation effect is, when I talk to you about are we underweight or overweight the various sectors, the allocation effect tells you the benefit or loss from the over and underweights during the period. It was basically a push for the period, which is not surprising since we're trying to, work towards zero weights for the most part. So there was not much allocation effect. All the effect came from the selection effect, or how are the managers doing relative to their benchmark? How are the managers doing relative to if we just index the portfolio? And so that's what we'll look at. That was 39 basis points. And so now we got to find out where did that come from. And in order to do that, we turn to page 14. We're starting to get really nerdy here as we drill in. The top part is breaking down the allocation effect. It was basically a push, so there's not much to look at in the quarter. To look at the selection effect, though, left-hand column, bottom panel, we can see that there were two areas that were, the bulk of the 39 basis point underperformance. Domestic equity, 31.031, and private equity, 0.22. So when you hear from the domestic equity and the private equity teams, you're going to get to the bulk of where the variance was versus benchmark. So that's just as a backdrop. If you look at the overall portfolio, turn to page 15, you can see from these charts, the blue chart, the blue bar is everybody with more than $1 billion, all the competing funds, or not competing, but all the other funds, and the black dot is us. If you go down to the bottom panel there, you see the black dot total system, minus 0.9190, that's the same 90 basis point underperformance I was talking about. There's a 47 next to it. That means we were in the top 47% of the blue distribution, basically in the middle. and we were a little better than the middle, 35th basis point over 2 quarters, 40 over 3 quarters. But as you look out, we're in the 30s and 40s pretty consistently for a lot of years here. That's not bad. It's nothing to write home about, but it's not bad. If that's it for the total, if we go back to the look at the portfolio on page 10, you can see where we are relative to benchmark. We're above on U.S. equities 3.1%, and we're below on long-term bonds in blue and purple, and above in short-term bonds in gray. Similar to what I've been saying for the last couple months, no need to repeat it much here. That's it for the total portfolio. I can set up a discussion with the individual managers, and let me turn it over to our new interim head of equities, John Mershberg, to give you the rundown on the equity portfolio for the quarter. John?
Thank you, Scott. If everyone would please turn to page 20 in the spiral bound book. We'll see that the total equity composite underperformed the Russell 3000 index by 91 basis points for the quarter. And this was primarily driven by the overweights to small and mid-cap stocks. The small cap Russell 2000 returned a negative 7.36% for the quarter, and the S&P 400 mid-cap was down 3.98%. This was in contrast to the larger S&P 500, which was up 1.13% for the quarter. And then moving on to page 21, we see that the small cap composite underperformed by 68 basis points for the quarter. 2 of the 3 active managers in the composite beat their benchmark, but the manager that underperformed for the quarter more than offset the good relative performance of the other 2 managers. Next on page 22, we see that the mid-cap composite underperformed the Russell Mid-Cap Index by 105 basis points. Of the 3 active managers in this composite, 1 beat their benchmark and the other 2 underperformed. The S&P 400 index fund, while beating its benchmark, also underperformed the broader Russell Mid-Cap Index. And then next on page 23, you see the Russell 1000 composite closely tracked the benchmark. And again on page 24, we see that the Russell 3000 passive account also closely tracked the index for the quarter. And wrapping up U.S. equity on page 25, we see that the emerging manager of managers composite outperformed the benchmark by 140 basis points for the quarter. Are there any questions on the U.S. equity section of the report? Okay, if not, I'll move on to the international equity section. If you would please turn to page 27. On page 27, we see that the international equity composite outperformed the MSCI All Cap World ex-US Index by 74 basis points for the quarter. Moving on to page 28, we see that the developed markets active composite also outperformed the benchmark by 51 basis points. And next on page 29, we see that the developed passive composite underperformed. This was because of the overweight to and the relative underperformance of the small cap passive account. Turning to page 30, we see that the developed growth active composite was ahead of the benchmark by 27 basis points for the quarter. Bailey Gifford underperformed, while Walter Scott had a very strong quarter, beating the benchmark by 164 basis points. Next on page 31, we see that the developed value active composite beat the benchmark by 151 basis points, with both managers outperforming. And turning to page 32, we see that the developed small cap active composite trailed the benchmark by 97 basis points for the quarter, with both managers in the composite below their benchmarks for the quarter. And on page 33, we see that the developed markets passive, small passive account slightly trailed the benchmark. And then wrapping up developing markets on page 34, we see that the developed markets large cap passive account closely tracked the benchmark for the quarter. Okay, then I'll move on to emerging markets on page 35. Here we see that the total emerging markets composite was ahead of the benchmark by 42 basis points for the quarter. Page 36 shows that the emerging markets active composite was ahead of the benchmark by 58 basis points, and 3 of the 4 active managers outperformed their benchmarks in that quarter. And then wrapping up emerging markets on page 37, we see that the passive emerging markets account was slightly below the benchmark for the quarter. Are there any questions on emerging markets section? If not, I'll hand it off, I believe, to Yvonne.
For REITs.
For REITs. Sorry.
Sorry, there was a shortage of books. So on page 38, we see the performance for the REIT portfolio, which is about 3.4% of the fire portfolio.
A little louder, please.
Oh, sure. The trailing 3 months is good, and also the fiscal year to date, where the fire portfolio is outperforming its benchmark. And also for the later periods of the 3-year, the 5-year, and trailing 10-year. Is there any other questions on REITs? Next, we'll hear from Brian on the ETI portfolio next.
Would you speak up a little bit, please?
Hi, I'm Brian. We're doing the ETI portfolio. Wait, are we at ETI already?
No, I think
Yeah, I was going to say, yeah.
okay. No, I think I'm up next.
Yeah, I think you're up.
Yes.
Fixed income,
Yeah.
page 40.
So turn to page 41. Page 41 shows a pie chart indicating where all of your fixed income assets are invested. And as you see on top, 31.9, nearly 32% of your assets are invested in fixed income, very close to your policy. And that comes out to $3.4 billion. Based on the chart, it's fairly obvious from the visual chart that the fixed income portfolio is dominated by the core fixed income program. The next page, on page 42, breaks down that core fixed income program into 3 subcomponents: governments, mortgages, and credit. Governments is labeled here as treasury/agency. In the pie chart, the blue slice is the government slice. That's the smallest of the sectors. I want to draw your attention to the over-underweight column in the chart below. This has been going on for some time now, where we've been underweight the government sector and overweight spread sectors. In a quarter, as our CIO mentioned, where we had negative returns and there was somewhat of a flight to quality, investors sold risky assets such as stocks and others. And what did they buy? They bought things, put money in cash, but also bought treasuries. So our underweight did not help. And on top of that, managers underperformed. However, as you'll see on the next page, the program still worked out well because of the overall performance. So to give you some context, despite what I just said, of all of the managers in the program, only 2 underperformed, and they were mostly in the government sector. And the reason for that is because in the government sector, because we're not dealing with credit risk, unless you're concerned about the Treasury being a credit risk, the issue is about duration. And in the quarter, because of the flight to quality, investors, as I mentioned, put money in treasuries, price went up, yields went down. Managers were not necessarily expecting that or set up for that, and so therefore had a challenging quarter. How did it all come together? On page 43, you'll see the results. The first two columns on the left, as others have noted, are the same because it's the fiscal year, the same 3 months as fiscal year. Returns are fairly modest on an absolute basis of 25 basis points, but even despite what I just mentioned, it was still ahead of the benchmark by 3 basis points. And looking at the column going from left to right, the 6.05 for the 1 year represented nearly 100 basis points above the benchmark. Similar on the 3-year basis, the return of 3.99 represented 97 basis points over the benchmark. Strong returns across, driven by the most recent period in the last 5 years, but nevertheless, on an absolute basis, modest compared to equities, but very, very strong versus the benchmark as far as individual managers go. To the point that on the long-term basis, the managers effectively all outperformed the benchmark except for by a few basis points in the government sector, as I described. Next page, page 44, shows Core Plus. That's really one manager. It's LM. That's our developing manager program. LM is a Core Plus manager, and they underperformed for the quarter by a modest amount, by 34 basis points. So they were just below flat line, whereas the benchmark was just over flat line. But for the longer time periods, in fact, if you look at the 5-year number, it's exactly 100 basis points ahead of the benchmark, which is for a Core Plus manager and for our program a very good result, especially given the very modest returns. 100 basis points comes in very handy when the returns are on an absolute basis point, on an absolute level, very low. Progress on the next page is our emerging manager and manager programs, smaller managers. Similar to LM, they slightly underperformed by only a few basis points, by 7 basis points for the quarter, but they're newer, so we only have a 1-year number here. We have a longer-term record. There's also 100 basis points, 102 to be precise, above the benchmark, so the program has worked out very, very well. Small managers have, in fact, done well versus the benchmark. Page 46 is tips, and we'll have more to talk about this later in the executive session. And the return for the quarter is negative, minus 2% precisely, which is 4 basis points ahead. So very close to the benchmark, and close to the benchmark even on the longer time periods. We don't show since inception, which is 9.5 years. We show that in the executive session. But similar numbers, very modest returns above the benchmark since inception. Here we show 5-year returns of 462, which is 14 basis points ahead. And again, like I said, we'll have more to talk about that in the executive session. High yield is on page 47. That's below investment grade. Spreads widened during the panic in the market in September and the first half of October, which is not included in here. October ended up well, as you'll see later on. But for the quarter ending September, the returns were minus 189, which were below the benchmark by 29 basis points. But for the 1-year period, we were ahead by 28 basis points, returning 740. And for the longer term basis, if you remember, we had some manager changes, so the 5-year number of 3 and 5-year numbers are very modest compared to the benchmark. And that's part of the reason why we had the changes in the manager lineup. But the longer term numbers, so for instance, take a look at the 10-year number. 10 years in high yield, the return is nearly 100 basis points ahead of the benchmark, and on an absolute basis, returning 780. So very, very strong. And compared to the volatility, a very good result. Bank loans on page 48 did what we expected. Both managers outperformed. It's a diversifier of the high yield portfolio, and it did exactly what we expected. We didn't have the negative returns, and for the 1-year number, lower positive returns, but that's expected because it's higher in the capital structure. Convertible bonds on page 49, because of the indirect correlation to equities, or higher correlation to equities, underperformed, and the return was minus 260, and the return, while high on an absolute basis, was below the benchmark on a relative basis. The benchmark for the overall program, not the individual manager's benchmark. In that case, they're actually outperforming. Opportunistic on page 50 is the Star fixed income has done very well for the quarter and for every time period shown. Unless you have any questions, now I'll turn it over to Brian.
We're going to turn it back to
I'm
Neil
sorry.
for hedge funds on page 39.
My mistake.
Yeah, so I'm going to make you back up a couple of pages to the hedge funds on page 39. And I'm probably going to sound like a broken record compared to last quarter, but it's relevant. So this chart does a good job of showing what's happened to the hedge fund program since inception. If you remember in the beginning, the trailing 3 years, the chart there, we're outperforming one benchmark and underperforming the other because initially we were out of balance. Now that we're more in balance, and actually the trailing 12-month performance is wrong because of a calculation due to the changeover in our custodian from Boney to State Street. The actual performance over the last 12 months for hedge funds is 7.39%. So we are outperforming both benchmarks, and that's due to the fact that we're more in balance now than we were when we first started the hedge fund program. One other thing to mention, you'll notice that in the last quarter, the markets got a little bit tougher, and hedge funds were one of the best performing asset classes. Most markets were down. Hedge funds made money. Now we don't necessarily expect that to happen every single time, but as Scott likes to say, when it does happen, we'll be sure to point it out to you. So, and that's hedge funds.
All right, so I think I'm now up unless we, all right, page 51. We have the economically targeted investment portfolio. I'd like to highlight that we're up 9 basis points over the last quarter, but quite happily up 119 basis points, or about 1.19% over the last fiscal year. And you can see these investments are doing exactly what they're supposed to be doing. They're performing in the down markets.
What kind of investments?
This is the economically targeted investment program. So this is the investment program that focuses on New York City, attempting to benefit low, middle, and moderate income New Yorkers. And if we jump to this book here, I'll walk you through each of the 3 programs we're using right now, and I'll go through the returns and what we've done so far. So starting on page 7 and 8, we have this chart which shows our historical investments, as well as a pie chart for those of you who think more graphically than. Our PPAR program is an investment program that does long-term loans. Because of that, it is less susceptible to the market cycle and tends to outperform in down markets. We are reaping the benefit of these investments right now. The PPAR program for FIRE is up 121 basis points during the last third quarter and 995 basis points over the last 12 months. That's in part because we got the loans reevaluated at last December, and when we did so, the value of the loans were rated up because interest rates have been so low. In the third quarter, the FIRE purchased over $750,000 worth of loans to create or preserve 635 units of affordable housing. And in the third quarter, FIRE also made $150,000 of forward rate locks. These are loans that will be coming to us in the next 2 years for 163 units of affordable housing to be created or preserved. We go to the next 2 pages, pages 9 and 10. We have AFLO CIO HIT. We have 2 programs with them, though they're measured on a single basis. The home and multifamily portfolio, this actually did miss its benchmark by 6 basis points in the third quarter. However, it's outperformed its benchmark by 45 basis points over the last 12 months. This is in part due to the fact that they give themselves a harder benchmark. They measure themselves off the Barclay Ag as a point of pride with no consideration. They currently are invested in 9,434 units of affordable housing. Page 10, which is the Workforce Housing Initiative, this tends to invest in large developments across New York City. In the third quarter, they invested $5 million in a Bronx Mitchell-Lama bond pool. So that includes Kingsbridge Arms, Scott Towers, and Woodstock Terrace for those who know and love the Bronx. And last, we move to Access Capital Strategies. They outperformed, on page 11 if I didn't say, outperformed their benchmark by 26 basis points in the third quarter and 102 basis points over the last 12 months, so they're doing quite well. This is a program that invests primarily in single-family homes with some investment in a few multifamily, focused more on the security side of the world. They invested in $86,000 in the third quarter, if I can speak, in 8 single-family homes. I'm happy to answer any questions or turn it over to, I believe, private equity.
Okay, private equity is up next.
Good morning, everyone. So we're back in the, we're in the same book that Brian was in. So we're starting on page 26 in the agenda book. Quarterly private equity report for the period ending June 30th, 2014. So I'll give you a second to get there. The big book, yep, page 26. Portfolio review quarterly highlights. And I think the key takeaway on this page, just as the second bullet point titled Recent Portfolio Activity, this has to do with the continued increase in your portfolio's valuations, net of cash flows, both quarter over quarter and year over year. The portfolio value increased approximately $20 million, or up 3% quarter over quarter, and the valuation was up over $100 million, or up 17.4% year over year. At the bottom of the page, you'll see some of your new commitments highlighted, and you'll see that Fire closed on $72 million in new commitments during the quarter. And then subsequent to quarter end, the plan closed on an additional $45.4 million of commitments to 3 managers. So if you'll please turn to the next page, page 27, we'll look at your active commitments and performance. And you'll see that as of June 30th, private equity represented 6.5% of total Fire plan assets relative to a 7% target, with a market value of approximately $696 million. Looking at the table on the column on the left under June 30th, you'll see that as of that date, Fire had $1.4 billion in active commitments across 99 managers, 154 funds. The market value at $696 million, unfunded commitments of $523 million, resulting in a total exposure of $1.2 billion. If you'll look at the very bottom of the page, you can see the portfolio since inception, internal rate of return increased slightly to 11.1% from 11% at the prior quarter end, with the total value multiple steady at 1.37 times. On the next page, page 28, we'll look at your returns on a vintage year basis. And just a couple of key takeaways on the chart at the on top of the page. The system posted very strong returns in the 2001 through 2003 vintages when compared to the benchmark median, and this was largely driven by strong performance from some of your early commitments to large buyout and secondary managers. Some of these managers that posted strong results for you are the Apollo Group, Blackstone Group, Landmark Equity Partners. However, when you start looking at, as you continue down the chart and you look at some of your 2004 to 2007 commitments, these have generally underperformed the benchmarks. And this is largely due to inconsistent pacing and an over-diversification of commitments to non-core managers. I think the good news, though, is as you look further down the chart, is that some of your recent commitments are starting to post very strong results in line with and ahead of the benchmarks. So it is certainly moving in the right direction. On page 29, we'll just look at your performance in a different way. We look at your portfolio's performance presented over various time periods against the program's public market equivalent benchmark. Just to remind you, that benchmark is the Russell 3000 plus 300 basis points. And you'll see that the portfolio generated an 11.1% net IRR since inception. This does lag the program's benchmark by 240 basis points. On a one-year basis, the portfolio generated a 17.4% net IRR. And while this is strong on an absolute basis, this does trail the program's benchmark. This is largely due to the continued strong performance of U.S. domestic equities, which is the benchmark we're measuring against. It's worth mentioning, though, that this 17.4% figure represents a 350 basis point increase when compared to the portfolio's one-year return as of June 30th, 2013 at 13.8%. So the one-year number is certainly a strong number on an absolute basis. Next, I just want to turn your attention just a couple more pages to page 29. I'm sorry, I'm still on page 29. If you just go to the chart on the bottom, you'll just see your portfolio performance broken out by strategy and sub-strategy. And you can see that large buyout at 26.9% since inception IRR, secondaries at 28.2% net IRR, and growth equity generating an 18.4% net IRR, continue to outperform for FIRE. Clearly there are other sub-strategies that are underperforming, and I think those are some strategies that we identified in the annual tactical plan months ago, and we'll continue to address those strategies, such as energy and co-investments. On page 31, we'll look at your portfolio diversification, and what you'll see here is that the portfolio remains diversified, with buyouts representing the largest exposure at 55% relative to a 60 to 85% target. We do expect this number to continue to increase as we source high conviction managers, two of which you'll meet later today that will be presented for recommendation. Pages 33 and 34 summarize the portfolio's cash flow activity. On page 33, it's depicted on a yearly basis, on an annual basis, and on page 34, your cash flows are broken out on a quarterly basis. And the last page I'd like to turn your attention to is page 36, which just takes a deeper look at the geographic breakdown of the portfolio. And this is at the portfolio company level. And based on market value, North America represents the largest exposure at 81%, Western Europe at 15%, with 4% exposed to rest of world. So that concludes the prepared remarks. Be happy to take any questions.
Any questions for James on private equity? Hearing none, thanks, James. Let's turn to real estate and Yvonne Nelson.
Okay, so continuing in the same book, good morning. We're on page 44, and we're going to go over the highlights of the real estate portfolio for the second quarter for the fire systems. There's a 5% allocation, as you know, to real assets, and that would equate to an allocation of about $535 million. Right now, real estate is one of the strategies that we invest in real assets. Shortly after me, you'll hear from Petra on infrastructure, but as it relates to your holdings in real estate, the market value of which is about $418 million. We have about $157 billion in commitments that we have yet to fund. So we have an exposure to real estate of approximately $550 million. And that's comprised of about 45 investments at this point. We have about 34 managers hard at work trying to deploy that capital on our behalf. And in terms of our portfolio construction pursuant to our IPS is comprised of core strategies and non-core strategies. Our IPS allows us to invest in those strategies between 40% and 60%. Right now, there's an overweight to non-core strategies. The non-core component of the portfolio is about 66%, and the core plus component is about 34%. So there's an overweight at this particular point, but it's actually something that we did deliberately shortly after the crisis in about 2011, 2012. We recognized that there was a lot of distress and market dislocation, and we thought that our non-core managers, which are about 25 out of the 34 managers that we have, could best execute strategies and add value to the portfolio. And these funds have an investment period of about 3 to 4 years. So I guess it would kind of make sense rolling 3 years forward to 2014, 2015, you'll start to see some of their contributions in your returns. So if we look over to the same page in the lower right, we look at the performance of the fire real estate portfolio compared to its benchmark. The real estate benchmark is a time-weighted return benchmark. It is the Odyssey benchmark plus a premium of 100 basis points on an after-fee basis in recognition of that core non-core blend that I talked about. If you look at the bar chart, fire is the dark bar, and you will see for the quarter that the fire portfolio produced a return of 4.5%, which was in excess of 160 basis points over the benchmark of 2.9. And as you look across, you'll see in the near term, certainly some outsized outperformance for the 1 year, over 100 basis points for the 3 year. But our IPS directs us to kind of look at how the portfolio is performing in the long term, and the milestone for the program is the 10-year, and the 10-year we are evenly matched with the benchmark. But just circling back to your non-core managers, in terms of their contribution to your performance. For the quarter, that 4.5% that you see there, you have the non-core managers actually produced a 5.9% quarterly return. So they are driving the returns at this point. We are certainly cognizant of the risks of the overweight, but we believe that it's going to be normalized over time as they continue to invest and monetize those assets on behalf of the fire portfolio. There wasn't much investment activity for this particular quarter, but after the quarter, post June 30th, you're aware that we talked about the upsizing of BREP Europe 4. So we committed an additional $6 million to that fund, which closed. And also the re-up for H2 special situations that we did last month, in fact, is now closed as well. So, we continue to move in the right direction in terms of the portfolio. Some of the other diversification metrics that are interesting are, in terms of our ability to invest outside of the U.S. We are about 16% ex-US at this particular point, and we're continuing to find the best opportunities that we can to move toward the 25% threshold that's suggested in our investment policy statement. So that kind of concludes a brief summary of what happened in the second quarter for real estate, and if there's any questions, I'd be happy to take them before I turn it over to Petya.
Questions for Yvonne? Okay, Petya?
Good morning. My comments would be very brief. As you know, infrastructure is the newest asset class for the fire portfolio, and the infrastructure portfolio is at very early stages of development. We have committed $35 million for the fire portfolio through 3 partnerships as of the end of second quarter this year. The net IRR so far is 10.4%. Again, it's still very early in the portfolio development, so that's at this point not very meaningful, but it is a good result. It is above the benchmark that is CPI plus 4, and right now this benchmark is 6.11. The net return, again, not very meaningful at this point, but above the benchmark at 10.4 for the quarter. One fund is investing, the other funds are still in the process of getting there, and actually as we go forward through the year, again, this report reflects the results for the second quarter. We would see one more fund starting to make investments. With this, my remarks are completed. If you have any questions, I'll be happy to answer.
Okay. Thanks very much, Petya. I will now turn back to Martin Ganz, who's going to give you a brief overview of what happened in October, and just to sort of acclimate you as as we talk to the managers in the executive session. So, Martin?
Yes, so everyone should have a copy of this in front of them. If you don't, we certainly have lots of extra copies here. So I'm going to try to be brief because a lot of the macroeconomic themes have been unchanged from the past several months. So I'm going to ask you to turn to, give me a moment, my hands are dry, to pages 15 and 16. This shows that the dollar has strengthened. On page 15 shows the dollar versus large basket of large currencies. Page 16 shows the dollar specifically against the euro. Because the U.S. economy is growing at, well, we consider it and we hear and we read anemic growth, 2% plus growth versus what should be at this point in the recovery, compared to other developed market countries such as most in the Eurozone, which are either in recession or teetering on the edge of recession, we're strongly ahead. In addition, because we're ahead of those countries in terms of economic growth, the Federal Reserve finished the quantitative easing program. We still have $4 trillion on the balance sheet, but they finished the quantitative easing program, whereas the equivalent on the European side, the ECB, is just starting to embark on that program. Japan, similarly, is continuing their latest program that has been going on now for 20 years in Japan. So we've wondered for a while why the dollar has not strengthened, because all things being equal, if you have a stronger economy and higher expected interest rates, we would expect that currency to be higher. Finally, that's occurred, as you see, going forward, so that should continue to occur as long as the U.S. versus Japan and Europe has the dispersion, as you'll see in a moment, as far as growth and interest rates are. If you turn to page 18, this will tie into some other information that we'll go through in a moment. This is the VIX, the volatility index. If you take a look, it looks almost like a flat line pretty much for the last 3 years where there was extremely low volatility. Then you hit that blip, which was September and the first couple of weeks of October, where the market started panicking. And now we're back down to where we were. Now, the last week or so, the market started going down, so volatility ticked up a little bit. But for purposes of this chart, what I wanted to point out was that volatility has been held artificially low by the Fed, historically low, and the reality is in September and early October, that blip that you see is actually doubling of volatility from where it was. Now it's come back down, so that just shows you how quick it can happen, and when it does happen, it usually coincides with the market going down. If you take a look on page 20, the 10-year Treasury, and I'll refer to this also later when we, in the executive session. The 10-year Treasury, when we printed this, was 225. It's actually lower now because the equity market's going down. When people sell equities, they either buy cash typically or they put it in Treasury. 225 is fairly low. One thing I want to point out, if you take a look, this shows 5 years, so the very beginning of the year, which is very easy to see because that's the last dotted line all the way to the right, was exactly 3%. And if you remember this time last year, the question was, QE is ending in the U.S. How high will rates go? Will it be 3.5% on the 10-year? Will it be 4%, 4.5%? Take your pick. Well, turns out that 3% was the high of the year. It never did go up. It went low. So if there is a consensus of what's going to happen in 2015 for rates, long rates, it's that the yield curve will flatten. Again, this is not everyone's view, but this is a general consensus. Yield curve will flatten, meaning at some point short-term rates will come up, but long-term rates, even if they do go up, will not go up as much as short-term rates go up. So overall, the yield curve will flatten, so you see the yield curve on the prior page. That's actually not a bad thing. Next page, which is also very interesting, page 21. Normally we show this, we don't go through it, but I want to go through it for a point, as we'll go through later as well. Take a look at the very end. I'm looking at the red line. The red is high yield. High yield spreads compared to treasuries. What are we earning as a premium to invest in riskier securities? We're earning 449 basis points at the time we put this chart up. Interestingly, while you take a look at the VIX, and the VIX came back down, and investors calmed down, investors still continued to sell high yield. It turns out that was the harbinger of things to come that we're seeing in the last week, which is that while equity markets calmed down and hit record highs after the first couple of weeks in October and then November and even early December, high yield spreads kept going, widening out, and that can often be historically an indicator, that a leading indicator that we're towards the late innings of the overall market cycle. Not always, but it can be. Page 25 shows how U.S. has done versus other large markets, and this is quite striking. Pointed this out in the past. White is U.S., yellow and orange would be EFA and emerging markets, and there's quite a dispersion. Part of that is because EFA is, for the most part, either in recession or much slower growth in the U.S., even though the U.S. growth is not that high. The other growth levels are much lower or in recession or negative growth. But also its currency, and that ties into the other chart. When the U.S. currency has now started to strengthen, even if the company prices are doing well, because in dollar terms, when it gets translated, our return ends up being currency. You end up taking currency hits if those currencies are weaker than the dollar. So how did the markets do in October? If you turn to this page, it's hard to read the page number. It actually says 27, but it's this page that starts with October. The first set of numbers is the Russell 2000. October is really a sort of two halves. The first half was a panicky half. The second half was when the market started roaring back. And we ended up high. I'm sorry, that doesn't sound right. We ended up higher as the market goes. And the second half of the month undid the downturn in the panic in the first half of the month. So if you look at the Russell 3000, in the first set of numbers, the return for the month was a very strong 275. The second part is very interesting. You see EFA was down 145, and that ties in again into the currencies. Currencies will hurt you. In fact, if you look at fiscal year to date, it's down 724. That's partially because the economy is in recession or close to it, but also because of currencies finally, the euro is finally weakening versus other large currencies. Emerging markets did well. Virtually every other asset class did well. In fact, if you look at REITs, the very last section of numbers on the next page, REITs did 10% in just a month of October. REITs are very sensitive to interest rates. So interest rates went down, 4 plus 5 was up, and REITs did 10%, bringing the return to 7% year to date. If you take a look at the next two pages, it's almost a mirror image of the pages that I just showed you. So November was very similar to October. Returns are high. The only difference here is EFA was positive instead of negative, and emerging markets were slightly negative instead of positive. Otherwise, the results were very, very similar. What I want to point out is this is where the high yield, why I pointed out the high yield chart. November is when the markets were hitting record highs. But if you take a look at the very first set of numbers on the next page, on the second page of numbers, well, the Citigroup BB&B was down 83 basis points. Why was it down 83 basis points when when other risky assets were up? That is usually a leading indicator that there's a crack, that there are some concerns that market participants are looking to sell while they can. And high yield, because of illiquidity, has that issue. There are other technical factors involved, but this is not unusual to see in the late innings of a market rally. But also, I want to point out the leveraged loans were down 46 basis points. While we're not happy that it was down, I'm sorry, it was not down 46 basis points, we're up 46 basis points. While we're not happy that high yield was down, the point of having leveraged loans is that they're floating rate notes and they diversify the high yield portfolio. So while high yield was down, and partially it was down because of duration and concern, the real reason that leveraged loans were higher is because they're higher in the capital structure and diversifies your portfolio. So putting it all together, what were the months? So if you turn to the next page on page 31, you'll see the bar all the way on the left, the return for fire was 139, which brings the bar in the middle to a positive number. Your return September, and you saw September quarterly, was negative. So October was a very good month, and you'll see November was a similarly good month, so you'll see similarly good numbers for November. December is obviously still ongoing. First half was good, and the last week has been a little shaky. So if you take a look, and our CIO mentioned this before, I see he's not here, so I'll mention this for him. We For October, if you take a look at page 32, where we're positioned versus policy, we're taking the overweight to equity down. And the good news is we've taken it down before the market downturn occurred. So if you remember when we started this several months ago, we were at the maximum of 6% positive. We're now down to effectively neutral. It shows here plus 2.8%. We're effectively down to neutral. As of October, we're 2.8% overweight. November, next month, you'll see a lower number. And when you see December, you'll see neutral. So those sales have already occurred. The underweight, however, to Core Plus 5 and TIPS still, for the most part, remains. And where you see cash that looks like a high level of cash in gray all the way on the right, it's not cash to in the traditional sense that it's overnight cash earning effectively 0%. We've been investing in safe 2-year paper earning about 50 or so basis points to earn some return. So when rates go up, the 4 plus 5 will be exposed to duration risk. It has a 6+ year duration, so we'll lose 6% if rates go up by 1%, whereas 2-year treasuries have very little duration. So you earn some return while waiting for the rates to go up. And once rates do go up, that's when we move the money back into the Core Plus 5. Scott, did you want to add anything to that? All the numbers and percentages are shown on page 34. Policies, numbers, percentages. The total market value was $10,736,000, and that's shown if you turn to page 37. $10,736,000. So you see that there's an improvement on the prior month. The record high was just short of $11 billion. When we get the November numbers, we do not have November numbers yet. We'll get that any day. As I mentioned to you, and you saw before, November numbers were just as good as October. So based on our estimates, you'll be awfully close to that record high number when we see next month in January what the November numbers are. On the bottom of page 38, we note that the 10-year return is 7.5%, 7.47 to be exact. The rest of the book goes through each and every public manager's returns versus their benchmarks. Are there any questions? Thank you.
Okay, Mr. Chairman, that concludes our remarks for the public session.
For the pension fund.
For the pension fund,
For the
correct.
pension fund, so what we need is a motion to move out of this public session, but to move into the firefighter variable supplement. We're gonna take a roll call of trustees, and we'll be in the public session at that.
So moved.
Second.
Any objections? Hearing none, motion carries. So, we need a roll call of trustees, the firefighter variable supplement.
Ms. Caroline Wilbur. Ms. Susan Vickers. Here. Mr. Rodriguez. Mr. James Lambert.
Yep. Did you get the visa?
Mr. Eddie Brown.
Big specialty
We have the and we start the meeting.
Thank you. The only item on the agenda is the quarterly report.
Martin, if I can interrupt, we have the report, we reviewed it, and we have no questions on the performance. Just if you could just give us an update on the benefits that were paid out.
Absolutely. So on December 15th, the VSF payment was made. It was approximately $50 million. I will send to you the precise amount because that's a rough estimate. It was off by a couple $100,000. I'll get you the exact number for you, but it was approximately $50 million.
Okay, thank you.
Anything else? Okay, and since that's the only item on this part of the agenda, we need a motion to move out of this public session and move into the fire officers variable supplement meeting.
So moved.
Is there a second?
Second.
Any objections? Hearing none, motion carries. We need a roll call of trustees for fire officers.
Ms. Caroline Wilbur. Mr. Sam Vickers. Here. Mr. Antonio Rodriguez.
Here.
Mr. James Mr. James McGowan.
Yeah.
Mr. John Farina.
Yeah.
We'll have a quorum and may start the meeting.
Thank you. So if you'd like, we can go through the book.
No, that's, we looked over the book, we're okay with it, and again, we just want to ask, okay, also the payout.
So we received the voucher. Obviously, your benefit doesn't get paid till January
January
31st,
31st, right.
but we did receive the voucher from the fire accounting group, the fire pension fund accounting group, and the amount is approximately $25 million. I will send you the exact number because it may be off by a couple of $100,000, but it's approximately 25.
Okay, thank you.
Any other questions? So we need a motion to move on to the public session and close the fire officers variable supplement meeting. And a motion to resume the fire department pension fund meeting.
So moved.
Second.
Any objections? Hearing none, motion carries. The roll call remains the same. And so we now need a motion to move into executive session.
Motion to move into executive session?
Second.
Any objections? Hearing none, motion carries. May we have